Steve here. All right, let's get right to it. We're about to break down a strategy for the market open that is purely mechanical. This isn't about gut feelings or trying to predict the future. This is a blueprint.
And I'm not kidding. When that bell rings at 9:30 a.m. Eastern, that's when the big money, the institutional players, they start making their moves. They are the ones who set the tone for the entire day. Our job isn't to guess what they'll do. It's to see what they're doing and follow.
You know, in that first wave of chaos, most retail traders, they just get destroyed. Why? Because they're gambling. They're guessing which way it's going to go. A professional, on the other hand, does absolutely nothing. They wait. They wait for the market to show its hand. And the opening range breakout, the ORB, that's the signal we're waiting for.
Okay, so let's get into the nitty-gritty. The very first thing we have to do is define the battlefield for the day. We need to draw some clear lines based on exactly what the market does right after the open.
The idea here is actually incredibly simple. The opening range is just the high point and the low point that gets set in those initial minutes of trading. Think of it like you're drawing a box around all that first blush institutional activity.
So here are the rules of engagement. For the first 15 minutes, you are a spectator. You just sit on your hands. Then, at exactly 9:45, you look at your chart. You find the absolute highest price it hit and the absolute lowest. You draw your two horizontal lines. That's it. Your box is built.
Let's make this real. Say we're watching the micro S&P, the /MES, and right now it's hovering around 6,908. We're going to use this as our anchor for a quick example.
So, in those first 15 minutes, let's say the price shot up to a high of 6,915. That becomes our upper line. And the lowest it dropped was 6,900. That's our lower line. These are our lines in the sand. Now we just step back and we wait for the market to choose a door.
Now you do have a choice here. You can draw this box based on the first 5 minutes of action or the first 15. And the decision really just boils down to a classic trade-off. Do you want to be fast or do you want to be right? Look, the 5-minute range gives you a signal by 9:35 a.m. It's aggressive, yeah, and it gets you into a potential move earlier. But it's also famous for fakeouts, where the price pokes out one way just to slam back in the other direction. The 15-minute range, well, it lets all that initial noise settle down. It gives you a much more reliable signal, and it's the one I absolutely recommend if you're just starting out with this.
Okay, listen up. We are now at the single most critical rule of this entire strategy. You can do everything else right, but if you screw up the entry, none of it matters. This is where real discipline is built.
So you've drawn your lines. The price is pushing. It's tapping right up against your upper boundary. Every single instinct you have is screaming at you to buy, to get in before you miss the move. But you don't. Not yet.
I'm going to say this again, because this one rule will save you more money than any fancy indicator out there. You must wait for a full candlestick body to close completely outside of your range. A wick poking through? Doesn't count. A price flickering above the line for a second? It doesn't count. You need a confirmed, solid, undeniable close.
Your trigger isn't a suggestion, it's a command. If a full candle closes above your high line, you buy. If a candle closes below your low line, you sell. There's no emotion here, no interpretation, and absolutely no second guessing. It is 100% mechanical.
Any professional trader knows their exits before they even think about their entry. This isn't something you figure out while you're in a trade. It's a non-negotiable part of your plan from the very start.
Your stop loss is your safety net. It's your ouch point. Let's go back to our example. If you buy the breakout at 6,915, your stop loss immediately goes to the other side of the box, down at 6,900. If the trade goes against you, you're out. The loss is small, and it was defined from the start. No exceptions.
And what about our profit target? We keep it just as simple, a 2-to-1 reward to risk ratio. The distance between our lines, our risk, was 15 points, right? From 6,900 to 6,915. So our target is simply twice that, 30 points above our entry. This simple math ensures that your winners are significantly bigger than your losers over time.
So let's just bring this all home. The opening range breakout, it isn't just a set of rules or a tactic, it's a philosophy. It's a complete shift from trying to predict the market to simply reacting to what it actually does.
So the most important thing to take away is this. Stop trying to be a hero at 9:30 a.m. Stop chasing that first crazy volatile spike. Instead, you draw your box, you define your terms,
and then you patiently wait for the market to prove its intentions and come to you. This is a game of patience. It's a game of discipline. You have to trust your setup, wait for your signal, and execute your plan without hesitation. That is how a professional trades. This is Steve. Respect the box, and I'll see you at the close.